All right, welcome to The Explainer. Today we are diving deep into a fascinating analyst report. We're going to be looking at Intuitive Surgical. You know, the company behind that incredible Da Vinci robot, and giving it a complete Wall Street health check.
So, what's the big deal here? Well, the report lays out this really interesting tug-of-war. On one side, you've got this company just knocking it out of the park with its performance, but on the other, you have a stock with a seriously steep price tag. So that's the big question we're tackling today. Is it actually worth it?
Okay, first things first, let's do a quick checkup and get familiar with exactly who Intuitive Surgical, or as you'll see it on the stock ticker, ISRG, really is.
I mean, these guys are the absolute dominant force in robotic-assisted surgery. There's really no one else close. Their Da Vinci surgical system is a total game changer, letting surgeons perform these incredibly complex, minimally invasive procedures. And get this for scale. In 2025 alone, their tech was used in over 3.1 million procedures. That's just a massive number.
All right, now let's get into the really juicy stuff, the numbers. Because wow, the company's recent performance was, well, it was incredibly strong. This is what really got Wall Street buzzing.
Now, before we jump into the numbers, we need to get on the same page about a term you hear all the time: street expectations. So what is that? It's basically the report card grade that Wall Street analysts set beforehand. It's the average guess of what they think a company will earn, and it's the benchmark everyone uses to see if the results are good or bad.
So check this out. In the fourth quarter of 2025, their revenue just exploded, shooting up by a massive 19% compared to the year before. I mean, in this economy, that is some seriously healthy growth.
And remember that report card we just talked about? Well, they didn't just meet expectations, they blew past them. They came in a full 5% better than what Wall Street predicted. And let me tell you, beating the street like that, it's always a huge green flag.
Okay, but here's a number that honestly might be even more important than revenue. The number of actual surgeries performed with Da Vinci robots, that grew by a super strong 17%. You can think of this as a key vital sign for the company's overall health.
And why does that matter so much? Well, the really crucial thing to understand here is that their business isn't just about selling these big, expensive machines. That's like selling a razor. The real money is in the blades, the instruments and services used in every single surgery. So seeing procedure growth means the machines they've already sold are being used more and more. That is the absolute lifeblood of this business.
And that brings us to another key term, the utilization rate. It's pretty simple, actually. Just think about a hotel. You want all your rooms booked, right? Same thing here. You want these multi-million-dollar robots to be busy, not just sitting in a corner. So yeah, higher utilization is always better.
Okay, so that's the rearview mirror. Now let's look ahead. What's the prognosis for 2026?
So the company itself is feeling pretty optimistic. They're projecting another year of really strong procedure growth, somewhere in the ballpark of 13 to 15%. But here's the other side of that coin. They're also planning to ramp up their spending, their operating expenses, or OPEX, by pretty much the same amount. You know, you got to spend money to make money.
But, it's not all smooth sailing. The report is careful to point out a few potential storm clouds on the horizon, what they call headwinds. We're talking about things like possible policy changes in the US, some economic pressure in Europe and Japan, and here's a weird one, the rise of those new GLP-1 weight loss drugs. Why? Well, they could actually reduce the number of bariatric surgeries, which is one of their key areas.
A GLP-1 receptor agonist is a medication that mimics the GLP-1 peptide. This is a hormone that your body makes naturally, and we know that in individuals with obesity, that these individuals sometimes produce lower levels of this hormone. And so what this medication does is it mimics this peptide hormone in your body, and it binds to the receptors. And we know that these receptors are in the brain and throughout the gastrointestinal tract. They're involved in regulating appetite, hunger, and satiety, as well as effects of hormones that are involved in blood sugar regulation.
So let's recap the health checks so far. We have a super healthy, thriving company, no doubt about it. But that brings us to the trickiest part of this whole diagnosis, the billion-dollar question. What about the stock's price? And honestly, research sums up the central problem perfectly with this quote. They say, "We remain fundamentally positive but sensitive to valuation on this stock." Basically, they're saying, we love the company, we love the business, but man, that price tag makes us nervous.
Okay, so to really get why they're nervous, we got to talk about something called the PE multiple. It sounds complicated, but it's not. Just think of it like this. It's how much you're willing to pay for a company's success. It literally tells you how many dollars investors are paying right now for every single dollar of profit the company makes. So a really high PE means investors are super confident and are expecting massive growth down the road.
And let me tell you, Intuitive Surgical's PE multiple is, well, it's way up there. It's in the stratosphere. The report points out that it's trading at nearly 70 times its future expected earnings for 2026. To put that in perspective, that's way, way higher than its closest competitor. And this chart really just drives that point home visually. You don't even need the numbers, just look at it. ISRG is that big bar on the left, just towering over everyone else. It's a total outlier, playing in a different league when it comes to valuation.
So that's the setup, right? Amazing company, amazing results, but a crazy high price. So where does that leave us? What's the final verdict from the analyst?
Well, here's how they try to figure it out. Analysts use these really complex models. One is called the discounted cash flow model, or DCF, to try and cut through all the hype and emotion in the market. Basically, they try to predict all the money a company is going to make in the future, then they adjust for risk and boil it all down to a single number, what they think the stock is truly worth today. It's fair value.
And here's the big reveal. After running all those numbers, the model spits out a fair value of somewhere between $420 and $475 a share. The problem? At the time, the stock was actually trading for almost $526. So there's a pretty big gap there between what the analyst thinks it's worth and what the market is paying. And that gap is what leads to their final rating, peer perform. Now, that sounds like a bunch of Wall Street jargon, but what it really means is, meh. It's not a buy and it's not a sell. It's a neutral shrug. They're basically saying, look, it's an amazing company, but it's already priced for perfection. We don't see it rocketing up and beating other stocks from this point.